So, hi everybody, thanks for joining us. This is Othalia Doe-Bruce. I am one of the managers at the Blockchain Hub, which is a non-for-profit organization with York University. And what we do there is education on blockchain technology. And so this webinar is going to be talking about crypto economy, which is one of the courses that we offer here. And so Brad Kirby, who is the managing director of DLT Advisory Group, was kind enough to propose to do this event to share his knowledge and experience on how you can actually evaluate a blockchain slash crypto slash token based project. So I think without any further ado, I'm going to let Brad introduce himself. And if you guys have any questions, please feel free to type your questions in the comment section, and we'll be able to answer them at the end of his presentation. All right, so Brad, take it away.
Can everybody see my screen here?
Yeah.
Yeah.
Good.
Okay. Great. All right. Well, thank you everybody for joining today. Appreciate your attendance. So I'll just jump right into it. Covering crypto economy and project valuation today. This will be pretty high level. So I'll just jump in. This is in partnership with TheInnovativeFinancier and the Blockchain Hub at York University. So just some background on myself. I'm a chartered accountant, CPA, as well as a CB Pro from York's Blockchain Hub program. I'm a certified blockchain professional. I have about 15 years of finance experience. Prior to starting DLT Advisory Group, I was with Brookfield Asset Management for 5 years. At Brookfield, I worked on a number of digital transformation projects as kind of the subject matter expert in finance, capital markets, and treasury. So kind of across Brookfield's fintech, their global technology stack. So working on integration, payment automation, loan automation, just really trying to make things as efficient as possible. And prior to Brookfield, I was at Deloitte for 6 years, and I split that between 3 years in Canada, 3 years in Cayman Islands, with a focus on financial advisory services. So that was asset recovery, forensic kind of technology services, as well as insolvency and restructuring in a post-2008 environment. I've always had a bit of an entrepreneurial background. I started my first startup in 2004. So 15 years ago now, I guess, and that was a tissue pack marketing company when I was still finishing up university. And I've worked with a number of startups recently. So after branching out on my own, starting DLT Advisory Group, I've partnered and been an advisor for a number of startups, and am an advisor today. One of which, Balance Now, they just got into Techstars Toronto Accelerator. It's one of the 10 companies there. They're bright young team of entrepreneurs. They're working on, I think, their third project now. Six Fusion and their project, which is called EdgeX. That's out of the US, more on the cloud distributed computing side of things, as well as working with a number of partners and other advisors through companies like BlockSense. So I've been able to learn a lot over the last year. I've joined the Standard Council of Canada's Mirror Committee for the ISO 307 blockchain and DLT recently. I'm also a contributor to a number of various professional publications. Just finishing the fourth part of a taxes and wealth management series with Thomson Reuters, with one of my associates who's a partner at Miller Thomson law firm. So that's kind of the high level background of what I've done throughout the course of my career and how it applies to to blockchain. So really more on the finance side of things, finance, regulatory, but also being able to develop practical use cases, and also just in terms of development process, kind of being a subject matter expert that can kind of read code, but barely, I'm not a coder by any means, by any stretch of the imagination, but that's the high level background. Just to give you my background into how I got into crypto, in December 2010 was my first time I heard of cryptocurrency. Was actually when I was in Cayman Islands. We'd recovered some hard drives from a hedge fund, and on it was a wallet. And at that time, I was tasked with figuring out what a Bitcoin wallet was. I don't think anybody in our group really knew what it was. And shortly thereafter, I was able to fully understand what a wallet was and how we could potentially recover it. And we were able to access the printed hard drive and obtain a seed phrase that the CEO had printed out. And ultimately, we were able to recover 500 Bitcoins, which at the time in 2011 was worth $1 per coin, I think. So, with Deloitte being the liquidators on that, it wasn't really worth our time to pursue the process of trying to liquidate Bitcoins in 2011. What they did after I left, that's a different story. I don't know, so I won't comment on that. But that's where I first was introduced to Bitcoin. So it piqued my interest and my curiosity. And when I moved back to Canada, in between Deloitte and Brookfield, I spent a lot of time researching Bitcoin and really trying to understand not only the cryptography, or not only the finance side of it, but the cryptography and the coding and the technical side of it. So, and then I actually mined Bitcoins in September 2013. I joined Bitcoin Toronto meetup in January 2014, which is now called Decentral. It's Anthony Diorio's company. He was the founder of Bitcoin Toronto meetup back in 2013. It's the same group that ultimately invented Ethereum, actually. So it's kind of interesting to look back on it and see some of the emails and some of the meetups from 5 years ago. There's 42 people that had accepted the Ethereum investment opportunity meetup group. So it's really interesting to see how it's evolved and how active Toronto's been in the market. Fortunately, shortly after, I tried to transfer my coins to Bitstamp. Bitstamp was hacked shortly thereafter, and I focused on my finance career. So back at it now, I'm really focused solely on the blockchain and DLT space. So not only cryptocurrencies, but also across enterprise and really just looking at all of the use cases. The main reason for leaving, I was looking for a job at a Big Five bank in the blockchain team, but hiring freeze ultimately led me to leave Brookfield and start my own practice. So I'll just jump into it now. Thanks for listening to that brief background. So today I'm going to try to cover the crypto economic ecosystem. So I'll start off with cryptocurrencies and the different types of kind of investment opportunities and assessment there. So that will start with mining operations and going into trading, as well as how to value cryptocurrencies. And I'll also get into some more advanced techniques such as staking of coins or tokens that run on a proof of stake consensus algorithm. So Bitcoin is proof of work. Ethereum's proof of work, but moving to a hybrid proof of work, proof of stake model. So if you don't know what that means, don't worry about it. I'll get into it in more detail. And then I'll also talk about some of the service providers, most of which are centralized and really just kind of traditional applications and not kind of really blockchain companies. And then I'll talk about initial coin offering, kind of the good, the bad, and the ugly story with ICOs over the last 2 years. and then kind of the rise of the security token offering since regulators kind of stepped in last summer in Canada, US, globally, saying that the majority of ICOs are securities and therefore need to follow securities laws, and then try to talk about kind of a true utility token offering. Finally, the last piece of kind of crypto is airdrops and bounties, which aren't really necessarily investments, but kind of free distributions of crypto assets that can be bought and sold and traded if they're actually legitimate. And then some of the actual financing methods, traditional public financial markets. So that would be stocks and bonds and ETFs that are actually listed on traditional capital markets exchanges. So I'll focus on Canada there and maybe some of the projects that are ongoing in those markets. So before I get started, just want to cover the disclaimer here. First, that the views that are expressed throughout are my own views. Nobody has really reviewed this except open to feedback and comments at the end if I didn't cover anything. And it doesn't reflect the opinion or the endorsement of these views by the Blockchain Hub. It's intended to provide general information only, so this is not by any means to be used to provide investment advice, legal advice, or tax advice, or be used to answer any questions about your investments. So if there are questions about that, please kind of take it offline. I'm happy to answer emails and try to put somebody in touch with the right professional. But in this context, it's we can't legally be giving investment advice over this presentation. And then just a redistribution note. All right. So kind of through the boring piece here, just going to talk about get into mining. So back in really the whole crypto asset space started on January 9th, 2009, when the first block of Bitcoin was mined. Before that, there wasn't really a blockchain economy. There was no crypto economy. And the real first investment opportunity was obviously, mining Bitcoin. So that's created the entire ecosystem that we see today. So that was mined by obviously Satoshi Nakamoto, the pseudonym for the individual or individuals that had the key for the first block. I'm not going to get into the ins and outs of who that is and who claims to be him and so on and so forth. It's a fun discussion, but it's a lot of he said, she said at the end of the day. So from there, just to kind of cover what mining is. Effectively, a mining operation is really just a data center with CPUs or GPUs or special chips like application specific integrated chips, ASICs they call them, that are now pretty much necessary for mining Bitcoin. You can still mine, call it altcoins or with GPU processors. So there's a lot of GPU mining facilities still that are mining different cryptocurrencies as they launch. So there's still certainly a lot of, it's a very big operation globally. So really, if you want to compare this to something, it really is like mining. So when you call it mining, you think the gold rush back in the early days in California, gold rush. It's really similar in the sense that all of these miners are really kind of sifting through the cryptographic protocol in hopes that they are able to mine a block of Bitcoin and therefore earn the reward associated with that block. So that's kind of fundamentally what the mining business is. Realistically today, as an individual or a small company, it's too big of a business for a lot of barriers to entry. So you'll see a lot of mining as a service or pools that will kind of pool resources and then distribute any block rewards to those users as a result of participating in that process. So just getting into it a bit. So globally, the largest mining business in the world for cryptocurrency today, I believe it's Bitmain, and that's valued around $13 billion. It's a Chinese company, Mongolia actually to be specific. But and then within Canada, there's actually a few public mining companies. Hut 8, I believe, has the largest facilities. They have a market cap of around 100 million. And then Hive Technologies is actually a Scandinavian company, but it's listed in Canada. So they have a number of facilities in Sweden, Norway, Iceland, where the cost of electricity is quite cheap. So there's actually opportunities to kind of gain exposure to mining or cryptocurrency mining by investing in some of these public companies. Again, not recommending any of them, but just pointing out what some of those are. And you know, as a retail investor, if you're looking at doing an analysis, then those companies are out there and projects that can be assessed. So again, they're traditional companies, and in terms of valuing them, it's pretty easy. Really, Hive does a good job of explaining it within their investor deck here. So just looking at this slide, again, talking about the data centers, effectively all of those data centers will have chips that are solving crypto equations and validating transactions. So they're either earning block rewards or earning transaction fees as a result of validating those transactions. And then there's obviously the inventory side of things where we'll get into what's kind of sparked the ICO boom, but as a result, there's been excessive inventories in the mining space, and liquidation has become certainly a business, and that lends into the trading side of things and actually creating a market for cryptocurrencies and that have been mined. So just looking at the profitability equation here, it's really the facility hash rate that they're using to effectively solve those equations, as well as the power consumption. So the costs of actually plugging in those servers within their data centers. So that's really the function there. So it's a pretty simple business model, but it's one of the early investment opportunities within this space. So just moving on from that, going to get into the trading side of cryptocurrencies. So similar to any other commodity that's been mined or extracted, like gold or even oil that's been extracted, they require a marketplace in order to kind of capitalize and convert it back to fiat currency or some kind of method of exchange to pay for their expenses. Obviously, a lot of energy providers require you to pay in Canadian dollars or Norwegian kroner, whatever the currency is. So there's certainly a demand to liquidate at least a portion of their holdings. And without that demand, there's obviously no value. So kind of getting into the what a lot of people have said about Bitcoin, and not necessarily cryptocurrency, but Bitcoin, is that it has no intrinsic value. So Norman Powell, the chair of the Federal Reserve, Jamie Dimon, obviously the CEO of JP Morgan, Warren Buffett, one of the richest men in the world, CEO of Berkshire Hathaway, and then my old boss at Brookfield, not to throw him under the bus here, but also came out and said he doesn't understand cryptocurrency because it has no intrinsic value. So while we can kind of get into whether or not it has intrinsic value, on that argument alone, you can also say that gold and the US dollar also have no intrinsic value, which, I think Warren Buffett would agree with that, but the others maybe wouldn't. Intrinsic value is kind of a security analysis concept, really, if you think about it, and it comes back to you look at Ben Graham's security analysis that Warren Buffett swears by, we're really talking about securities and not kind of units of exchange. Sorry, just trying to minimize this. So, but to say that they don't have economic value is really just another statement altogether that I'm pretty sure everybody in this space disagrees with. So gold is an example, comparing it to Bitcoin and other cryptocurrencies. It's still used today as a store of value, and paper fiat currency still fluctuates in relative value versus other currencies. And you could argue that the balance sheet of the country and its interest rates all kind of impact the valuation of that currency. Also, most of those currencies were once backed by gold, during the gold standard days. So going back in a kind of a economics history lesson or a history of money lesson, it's really hard to say that there's no economic value. The argument around gold is that if you take the total value of gold globally, call it $7.5 trillion, and you put it all together and you put it in one big block, what's the real utility around that big hunk of gold? There's no real utility to it. So that's kind of the argument around, no intrinsic value in gold, and so to have intrinsic value, you need utility and so getting into kind of I want to pick on Brookfield a bit here, just because to say that gold has no value is pretty interesting, because they actually have gold on their balance sheet. So they have a mine in Timmins that's a palladium mine, but one of the byproducts is gold. So they do mine gold. So it's funny to say that they won't invest in something because it has no intrinsic value, but then they hold valuable assets that also have no intrinsic value on their balance sheet. So it's a bit of a hypocritical stance, in my opinion. And then if you look at fiat currency, which even has less intrinsic value, it's just paper printed by central banks. If you have investments in foreign currency, there's actually if the value of that currency depreciates, then the value of your assets depreciates. So there's certainly an impact on valuations and economic value that needs to be considered. Brookfield, again, the largest Canadian investor in the UK, so they have a major pound exposure. The USD functional, a lot of Canadian assets, and about $30 trillion foreign currency derivative hedging program. So it's in terms of trading, so it's pretty substantial. Without question, a reduction in the economic value of 1 ounce of gold or 1 pound to 1 USD would reduce, their overall valuation, really. So at the end of the day, these are assets that have some kind of value, maybe no intrinsic value, but there is certainly value in that they're used as units of exchange or stores of value within the economic system that we live in. So taking all that, it's even more applicable to cryptocurrency. Go to the next slide. So we'll talk about the other ones as well here. 2 weeks ago, JP Morgan released JP Morgan Coin. And Jamie Dimon said at their annual investor day, he's like, JP Morgan Coin could be internal, it could be commercial, it could one day be consumer. So he's actually touting cryptocurrency at their annual investment conference. Now, I will say in his defense, he's always said that Bitcoin is fraud. It's specific to Bitcoin, and his view on Bitcoin as a individual cryptocurrency is his view. I don't think he's ever come out and said anything negatively about blockchain or the entire cryptocurrency ecosystem. But again, his argument is around intrinsic value, which I find kind of laughable at times. And then just a quick picture of a rat there as well. That's Warren Buffett called Bitcoin rat poison. And I'm not going to comment on that either, but my experience hasn't been the best with Bitcoin, but at the same time, it is really, it's proven to kind of hold true over the last 10 years. that it's can't be taken down really. So, all right, just going to move on to the valuation aspect. So again, coming back to cryptocurrency, and in many ways it's actually better than gold as a store of value or fiat currency as a medium of exchange, due to a number of factors. There's a finite supply. The total supply is 21 million, and I would say it's even less than that when you factor in all of the lost coins as well as fraudulently stolen coins. So in terms of the total available supply, it's actually probably lower. Whereas gold supplies are still found globally, and obviously there is a finite supply, but nobody knows necessarily what it is. And then governments can print money at whatever pace they like. To obviously will drive up inflation, but we've seen that happen in a number of governments globally over the years, where there's really not a true finite supply of fiat currency. So really, in that sense, it's better in terms of efficiency. Has potential to be more efficient than gold as a store of value. If you think about gold, it's not something you can't just shave off a piece of gold and use it. Whereas Bitcoin's actually divisible, to 8 decimal places into Satoshi units. Effectively, they're called. So one Satoshi unit is 8 decimal places, and so there's certainly efficiency there in terms of transacting those store of value. I think a lot of people will agree that Bitcoin as a peer-to-peer payment system to be used as a global medium of exchange is probably not likely. However, there's a number of solutions being built on top of it called layer 2 solutions, such as the Lightning Network, that are solving those problems, and using Bitcoin as the underlying store of value, and solving those efficiency issues with it being a medium of exchange as well. The decentralization aspect, obviously, there's no central authority that has power over supply, so nobody can change that unless there's a majority vote effectively to fork that code and create a different supply, which has certainly happened with Bitcoin. It's been over 100 forks of Bitcoin over the years. Most of them haven't really maintained any value, but it's certainly possible to change it. However, you do need the majority of the network to agree with it. Moving on from that, regardless of whether or not Bitcoin or other currencies have any intrinsic value, it can be measured and is useful in some aspects of valuation theory. So where this comes in is if we use Metcalfe's law, which is V equals N squared, it's effectively the value of a network is equal to the number of users squared, which was first used in relation to telecommunication networks, specifically cell phones. So if you have one cell phone in a network, there's really not much value to it, but as you add 2 phones, 3 phones, it becomes exponentially more valuable. And this holds true within a number of technology networks. Users within Facebook, let's say, that's definitely, even Uber, like valuations, that's held true. So it also holds true on peer-to-peer payment networks, such as on which cryptocurrencies are based. So it's just one kind of overarching valuation thesis. So basically, as more people use Bitcoin, or applications are built on top of Bitcoin's protocol, the more it increases in value. Let's say Bitcoin, this could be any cryptocurrency or crypto asset that has its own foundational cryptographic protocol. Sorry. So moving on, layering that in with kind of blockchain, which I'll call Web 3.0, and comparing it to where we are today, the web, and call it Web 2.0, and that's the Googles, the Facebooks, the Netflixes. You're seeing all of the value within the current web or the internet. All of that value creates to the application there. And there's a big reason behind that, and that's really that those applications are the ones gathering all that data. So the protocol layer, the internet, if you think about it, you have HTTP, you have TCP/IP addresses, you have SMTP for email. Those protocols that were built, the foundational technology on which the internet today is based, there's really not a lot of value within those protocols. Again, because that layer, there's no monetization from the applications that are built on top of it. Blockchain is actually the exact reverse, because of the distributed databases and as well as the cryptographic security around that protocol. So the application itself, while it does add value to the protocol layer substantially through network effects, the applications themselves don't necessarily gain the same kind of value, and that can be explained again through Metcalfe's law, really. So this fact protocol theory, again, it's a theory; it's not a law, or was founded by Union Square Ventures 3 years ago. So it's kind of held true, but it's a very interesting theory, and I find it one of the most interesting ways to look at how blockchain could be disruptive versus the web we know today, and why some of those protocol layers, be it Bitcoin or Ethereum or 0x protocol, Augur, all these different protocols that are working together to develop this ecosystem, those are really where that value is going to accrete. So we're not looking really for not necessarily looking for the next Facebooks or Googles per se, unless they're built into kind of a protocol layer solution. So it's an interesting way to look at it. So really the fact protocol theory, so I talked about this already. So really app coins don't hold the same kind of promise. However, the people that are invested in the protocol there are actually some of the same people that created the internet, really. So one of the protocol tokens is, let's use basic attention token as an example. BAT, it was founded by the co-founder of Mozilla, Firefox. He created a new browser called Brave. I don't know if anybody's heard of Brave, but it has about 5 million users now. It's actually faster than Chrome. It's faster than Firefox, and it doesn't gather your data and use it for advertisement unless you opt into it. And if you opt into it, you actually get paid in these tokens for opting into it. So it's created kind of an interesting protocol there for browsers, and that is an interesting use case in this scenario. So taking that fat protocol theory and applying it to using Metcalfe's law, you can see that the app coin values in isolation don't add up to the same kind of value as called the protocol coin tokens, because they're in isolation and they need to grow their value individually through their own user acquisition, their own nodes. Whereas under a distributed application environment that is built on top of a Bitcoin protocol, each new user and each new node that is from that application is actually adding to the protocol layer. So it's actually exponentially adding across the entire ecosystem. I'm going to bore you with some math really quickly here. So this is really just what I was talking about. So if you have 3 decentralized applications, call it CryptoKitties, Polymath, and MakerDAO or something on top of Ethereum. Each of those applications had 3 nodes. Well, each of those applications in isolation is going to be worth about $9, let's say, if you look at this theory. So in example 2, 3 times $9, you get $27 across those 3 applications. However, if you look at the value of Ethereum, because each of those applications are adding to Ethereum nodes in Erlang, you're actually adding 9 new users or 9 new nodes within the Ethereum network. So that's really exemplifying what network effects are and how they actually add a lot more value to the protocol layer here. So you can see the difference in the dollar amount. This is again very theoretical and certainly not by any means scientific, but it's kind of a good academic exercise to see the impact of network effects on valuations of cryptocurrencies and crypto assets. Getting into some more technical valuation methodologies. So these are kind of the different asset pricing methodologies that are used today across the whole ecosystem. The top 5 are all what I would call new or crypto asset pricing methodologies, whereas the bottom 3, your typical capital asset pricing model, discounted cash flow, and kind of comparables or relative valuation models, which are all traditional approaches used in kind of finance 101, I would call it. Store of value, token velocity thesis are kind of covered under what's called the go to the next slide here. It's MV equals PQ, so it's effectively the where the money supply times the velocity of money supply equals the price level times the index of new real expenditures. And what that's really saying, in the case of, call it a crypto asset that has a fixed money supply, it's really saying if the velocity of the money supply goes up, or if it gets effectively, if there's more transactions within the ecosystem, so it will actually drive the price level up concurrently, all things equal. So in the case of Bitcoin, let's say in terms of global transaction volume, it covers 1%. If that increases at 10%, the theory is that by the transaction volume going from 1% to 10% of the global, call it total addressable market for transactions, then the value of Bitcoin should theoretically increase tenfold as well. So that's really kind of the theory. And when you look at people valuing Bitcoin on a global basis, they're really looking at it, replacing gold as the replacing the $7.5 trillion of gold that we have. So when you hear valuations of $350,000 per coin, that's really, 7.5 trillion divided by 21 million total supply gets you to your effective 350,000 price level. So that's kind of where, when people say it's going to go that high, that's saying, okay, it's going to capture the entire market for store of value. So really, it's a bit of a pie in the sky concept, especially when you start factoring in all the other cryptocurrencies that are being created and the competition there. So that's really what people are looking at today. Hopping back to, I won't get into the INET valuation model too much. It's pretty technical, but I have a good spreadsheet here. Just pull it up that covers it. It really just takes a lot of the inputs and outputs and pops at a number. This was only created a couple years ago, but we'll get more into this in the actual course itself. But I just wanted to mention it as one of the opportunities. But really, this MV equals BQ equation is what people are using at asset management firms today. So the idea is with utility tokens, because those utility tokens are within their respective ecosystems, the idea here is that they'll, as more and more tokens come on, it's just going to become too overbearing for people. So the price effectively approaches zero because of the velocity, the turnover kind of decreasing over time. Just want to stop for a second. Is there any questions? Stage? No? Okay. So I'll move on to staking within cryptocurrency. And this is really just with respect to a specific type of cryptocurrency, and that's one that uses the proof of stake consensus algorithm. And what proof of stake is it effectively, it's effectively I mean, there's different types, so I won't get into the details, but look at it like a lottery system where people can actually stake their coins and say, I'm going to hold my coins and I'm going to use them to validate the network effectively. And what those stakers are usually called are master nodes. And master nodes, it allows for kind of a passive but steady income stream to those stakers. Sometimes very profitable, and it often provides, it's often a great use case for people that are planning to hold cryptocurrency for a long time. Some good examples: Dash was one of the first cryptocurrencies. Cardano is another. Lisk, Decred, are all proof of stake or hybrid proof of stake cryptocurrencies. Most of them have certain minimum capital requirements, and using Dash as an example, you need 1,000 coins to stake, which used to be a lot more, but at today's value of $80 a coin, it's $80,000 of Dash that you require to create a masternode or to stake coins and earn fees off of validating transactions on the Dash blockchain network. So there's a number of companies doing that. In Canada, there's one company called Neptune Dash that is really just a masternode. It's actually a publicly listed company on TSX Venture Exchange. I think they have a market cap of maybe 6 million, but I'm sure it was a lot higher at crypto peaks, last year. There's also a number of websites that assist with staking economics, such as stakingrewards.com. In practice, the implementation can be a lot more difficult, though, and it can be quite capital intensive, and staking periods in terms of getting your coins returned can take some time as well. So I think that's actually one of the reasons Ethereum is, bringing on proof of stake at a cautious pace, because they don't want people to stake Ethereum and then have it locked up for 6 months and unable to kind of access that. So, and more recently, you've started seeing staking as a service similar to mining as a service. There's a company called Staked that was just invested in by Pantera and some of the larger players in the blockchain VC space. And then, as I mentioned, Ethereum has a roadmap of adding in proof of stake as a hybrid option. And really what that's doing is it's making the network faster, because you're not relying on all of these distributed databases to validate and agree. You're kind of taking a subset of that and creating a trusted ecosystem within that specific cryptocurrencies ecosystem. Centralized applications, there's obviously a lot of them. These are out of scope for this discussion. They're really just, a lot of them are financial institutions. Coinbase, Circle, $8 billion, $3 billion valuations. They're centralized exchanges. They're not blockchain companies. They might hold cryptocurrency, and there's certainly a lot of blockchain elements to it, and they definitely have a role to play. I'm not knocking them at all, because they act as a bridge between the centralized world that we live in today and decentralized crypto economy. So there's certainly a lot of use cases here, but I think in terms of crypto economy, we're staying more towards blockchain and decentralized projects for this discussion. So moving on to initial coin offerings or token offerings. It's been $28 billion raised across over 1,500 offerings in the last 2 years. If you look at the charts, really 2018 was a banner year for cryptocurrencies. Those 2 big months in March and June were kind of bumped up by Telegram and EOS. EOS was $5 billion, and Telegram was $2 billion raised. So those are kind of the mega ICOs that have tipped the charts here. But you've really seen ICOs drop off a lot in the last call it 9 months now, and really you can see it by this chart. July there's 145 token sales, whereas last in January there's only 24. So it's definitely dwindled as a form of financing. It's not dead, but it's definitely lost traction, and it really hasn't proven out to be as disruptive to IPOs and VCs as we kind of thought it might be. If you look at total capital raised by IPOs cross-border in 2018, it's about $219 billion. This is up 6.4% from 2017. So really not a big dent. It's about 10 times the value of ICOs in 2018. The big factor with ICOs is the SEC and a number of other regulatory bodies have subpoenaed dozens, if not hundreds by now, of ICO companies and settled with many of them. So that's really one of the main reasons why the ICO model has lost traction. So the CSA as well is another that in Canada that's come out, and they've actually released staff notices that cover 14 different types of examples that they've seen and why they're out of scope or why they're securities. And the Howey test, which is really just is it an investment, is it a security contract, is kind of this old test that's very applicable still to these investments, and it's that's kind of the main test that people should be looking at. And really, the Howey test is it an investment of money? Is it in a common enterprise? Is it with an expectation of profits? As it from the efforts of others? So those are the 4 criteria that they look at to determine whether or not it's a security. In practice, it's much more complicated than that, but there's been a number of models assessing ICOs, and the one way that some of these have gotten around it is by filing exempt offerings. So they might file with the SEC, but they'll call it an exempt offering because they're saying that they're only offering it to accredited investors. So in SEC, it's a Form D filing, and effectively they're saying we're only offering this to accredited investors. So investors that meet specific criteria, they have a certain wealth amassed, or they make a certain amount of money per year. But in practice, a lot of these ICOs really just had a box. I remember looking at a couple of websites where they just had a box, are you an accredited investor? And you check the box, and that's all they did. Unfortunately, to do KYC and AML around your investors, you have to do your own due diligence. You have to get pay stubs and T4s, and you actually have to do your own KYC on every one of those investors. So when somebody's got 30,000 investors globally and they say that they've done their KYC on them, it's possible, but the cost would be substantial again to do that. And at the end of the day, most of these ICOs are not covering the material that investors require to make a knowledgeable investment. So the risk has often been way too high in most of them. So ultimately, they've just contained a number of major flaws that have given rise for compliant offerings, which we would categorize as either security token offerings or a utility token offering, where it's actually a true utility token that actually doesn't meet the definition of a security. Not going to really get into those too much today, but the security token offering is really the one model that we'll look at briefly. Just getting into the ugly side of ICOs, there's been a number of hacks, a number of thefts. Biggest one being kind of the DAO hack, decentralized autonomous organization. This was an ICO that raised $150 million, and effectively the attacker was able to put in some recursive code that effectively created a loop of paying as people paid in Ethereum to this kind of master DAO. It was sending the Ethereum to child DAO through this code that the attacker had put in, and they were able to actually walk away with all 150 million Ethereum. Blockchains are supposed to be immutable, but in this case, the Ethereum community agreed to go back in time and do a retroactive fork from the block prior to this happening. This created a fork, and Ethereum is actually the without the DAO hack, but Ethereum Classic, which maybe had about 2% of the value of Ethereum, still exists today. So that person that got away with it probably still controls 2% of 150 million through Ethereum Classic. So it's kind of an interesting story and a bit of an argument around should blockchains be immutable, or is this a special circumstance? I'm obviously of the camp that the fork was the right thing to do, but the purists will certainly argue this to death. Also around ICOs, you have a number of exchanges that are not regulated, they're offshore, they're through cryptographic measures, they're not really necessarily trackable. And obviously with kind of the privacy of cryptocurrency, there's been a number of pump and dump schemes, really unprecedented. So the Wall Street Journal actually said that in August 2018, that at least 825 million was lost in 6 months during crypto pump and dump schemes across 175 different schemes, 127 different cryptocurrencies. So it's just an example here of one of those. So really, STO, why an STO versus traditional equity? An STO typically should still be a blockchain business. It also gets into, think about tokenizing everything. Everything's programmable through smart contracts. ERC20 tokens or ERC721 tokens that are available. So this will allow for almost real-time settlement, automated dividends, a lot of the middlemen getting cut out, and global access to those markets. This is just a graph of the STO ecosystem. I won't get into it too much here. Just looking at the time. One interesting piece here, Spice VC. This is actually the first venture capital firm that has its own tokenized. Call it share of that fund. So they only invest in ICOs, and it's kind of an interesting model. So they were trying to disrupt the VC model, but and I think they're still doing okay, but it's certainly one if you want to look at. It's an interesting business model that was brought out. But most of the VCs are really looking at, really structuring these as securities so that they're protected still, because ultimately securities have a role to play in our economic system. I mean, there's a reason why capital markets are how they are. It's just there's a lot of legal rights that are protected that if we're suddenly at the mercy of buying these tokens under which there's no terms defined, it certainly adds a lot of chaos and a lot of risk that most investors shouldn't be willing to take on. So this is the high-level overview of what I would go into on an STO strength analysis. It's by no means all-inclusive, but it's what I brought to a number of clients and said, okay, well, look, for structuring an STO, these are really all the different considerations that you need to be addressing before anyone asks you any questions. So through the development of a white paper, a business plan, as well as a technical paper, yellow paper, that's kind of what ICOs have done historically, but also structuring this into almost like a prospectus or an offering memorandum that would be seen with traditional securities, because at the end of the day, it is a security token, so it should really near that kind of transparency or security. I'm going to jump through a lot of this. Executive management and the team. This is really common to any startup. So I'm not going to get into too much detail, but this is all really common around any tech startup, not just to blockchain. Within the advisory board space, it's a little bit different just because when I was talking about the protocol and the network effects, the advisory board has a more important role to play in terms of being ambassadors of that ecosystem and advancing it, and really trying to put partners together that will add value to the foundational protocol there. So there should be kind of it shouldn't be a siloed approach. It should really be a community team effort where we're all working towards common goals, and so that's where being an advisor is a little bit different than a traditional startup. Development team is very similar to technology startup, except that blockchain development is a lot harder. There's still a number of tools that are being built, so it's still very nascent, the space. So there's certainly there is a demand for blockchain developers, and blockchain developers tend to be quite talented just because of the challenge involved with building on blockchain. So certainly important to look at who the development team is and what their experience is. Again, going through an investor network, this becomes more important again in blockchain because VC investors tend to invest within an ecosystem so that there are network effects within their portfolio. So if you look at all of the kind of top blockchain VC firms, that's you'll see a lot of that within their portfolio. Project feasibility, really again, stepping back and looking at the problems. Is it really a true problem being solved, or is it really just an idea that someone's spinning into a blockchain concept? Is a blockchain really needed? It's certainly one of the first questions that should be asked at any stage. You can't just throw blockchain at everything. Really, in reality, a blockchain database isn't necessarily the right solution for a number of reasons. Mostly the fact that it's distributed databases. You run into a lot of challenges with that data. Business model, I'm going to skip over that. That's pretty standard. Tokenomics. Tokenomics is a very nascent sub area as well, but this is certainly probably one of the most interesting areas. And really, you're looking at how that token has been set up and what's the transparency around that token, because of the lack of standardization. So there's been a number of projects. Consensus leads one project called the Brooklyn Project, and I think they have a pretty solid core framework around whether or not that token, whether it's a strong token or not, just based on the characteristics. So when doing due diligence on some of these projects, there's a good scorecard that has been developed, and I think I have my own version of it that's really, it's still in draft form, and it's not, doesn't constitute any kind of investment model, but it's I find it really useful for poking holes within the tokenomic setup of specific tokens. A number of firms published books on this, really, like literally 100-page PDFs that are quite interesting. But again, it's very nascent in terms of how things are playing out. This is a changes every day kind of area. Stable popular in the last 6 months with some of the exchanges in the US gaining regulatory approval. Stablecoins are kind of digital fiat currency, call it. So JP Morgan would be a stablecoin, for example. So Gemini was the first one with the Winklevoss twins. Their exchange had the Gemini coin, which was pegged to the US dollar. Airdrops, bonuses, bounties. This isn't really an investment opportunity, but an airdrop is really the process of distributing a token or a utility token to an existing community, either for free or sometimes, which is sometimes unwarranted. People could take existing Bitcoin or Ethereum public addresses and distribute it according to the balances as of X date. So send it to all holders, and there's a claim. And then sometimes it could be as a reward or a bounty. So that's with rewards are given for contributions to within the community, whether it's on forums or through some kind of surveys. There's a number of different ways that rewards can get distributed. A lot of airdrops have been really just kind of get rich quick schemes or phishing schemes, but there have been a number of around network effects and user acquisition, distributing more tokens that have utility to people, in an online community per se, actually does add value to the security token that maybe has been previously offered. So there's certainly kind of a lot of reasons why people do it. So it's really just incentivizing people to use their token. So it's not necessarily to cash in or try to capitalize for cash. Stake a BitTorrent, and they'll be releasing that over time. Tron is one of the big blockchain cryptocurrencies that I think is releasing cryptocurrencies over the next 6 years till 2025. Dfinity is another one that did a $35 million airdrop. Dfinity is still not really a token. They've received funding from some of the top VC firms. I think their current valuation is estimated at $3 billion. Kind of calling themselves Cloud 3.0 and focusing on disrupting Amazon Web Services and looking at distributed computing and various. They're really just researchers that are trying to create, the Web 3.0 movement of where some of around the data and the computing. So it's a very interesting area, but still yet to be seen where they're going, and it's probably still a long ways out. And kind of last slides here before we go to questions. Just looking at some of the public securities in Canada. This is just a list that I pulled together. It's not to be comprehensive, but you can see most of them are on the Canadian Stock Exchange or TSX Venture Exchange. There is one company listed on the Neo Exchange called Ether Capital that's interesting, and it's certainly valid, but what their mandate is to invest in Ethereum-based projects. To date, most of their investments have really just been in Ethereum. So it's their market value has probably been correlated to the price of Ethereum, but they certainly have they have a lot of support, and they have a strong board. They have strong management. Brian Mozoff, CEO there, is very strong. He just got elected to the OSC FinTech Advisory Committee. The founders of it, Som Safe at Purpose, and then you have like John Ruffalo was on the board, Joey Krug from Pantera. They have a very strong management team, and these guys are very talented and know the ecosystem. So while this company on a standalone basis might not be, there's certainly other things they have their hands in that are interesting to follow. We also have some portfolio managers, Victory Square and Block One on here, a number of mining companies, and this had been the product of reverse takeovers from actual natural resource mining companies. That reverse takeovers are kind of a legal strategy used to kind of avoid relisting or kind of doing a IPO from scratch and doing all of the filings that come with that. So in my head, this dilutes investor, in my personal opinion, it dilutes investor information a little bit. It also makes it a little bit harder to distill what's actually going on with the company, whether there's any hidden liabilities. So when analyzing these, I just caution people to do their background checks and their history checks on these companies. And it doesn't mean because, you know, company A was bankrupt at one point that it's a bad company, because it's a completely different company today. But I definitely recommend increasing due diligence around a lot of these. Example, Long Island Iced Tea, their shares soared after they changed their name to Long Blockchain Iced Tea. Prices went through the roof. They actually got a slap on the wrist for doing that from NASDAQ. I think they're listed on. And there's a lot of red flags, so I'm not going to go through them. I just went through them high level a minute ago. And then you also have ETFs. So there's a few ETFs listed in Canada that you can look at to get some kind of blockchain exposure. Most of these are not necessarily blockchain companies in the underlying portfolios. They might be, you know, they might be like NVIDIAs that are producing ASIC chips for mining, and IBMs that are, you know, definitely leading the charge in some of the IBM and some of the enterprise blockchain work. So there's some indirect blockchain exposure in a lot of them. So those are just traditional securities that you look at. So not necessarily within the scope of this seminar, but just wanted to point them out as you know, projects that are gaining exposure within the blockchain space. That's about it. I went through it a little bit quickly, so I just wanted to stop here to take any questions. Anybody? Just type it down below if you have any questions. Talia, is anybody able to speak if they have questions, or is it just through the chat?
Right now it's just through the chat.
Okay.
But
did you have any questions?
So give me a second and let me see what I can do here, because I'm sure people have questions, but
yeah,
maybe there is a technical difficulty. Do you see anyone?
I can see yours, but nobody. I can see you typing it.
Okay, 1 sec.
But I don't. Rumi, I see you on there. I see you and Mike. Any questions? Rumi's one of Rumi and Mike work. They're advisors that work with me on a number of projects, so they're pretty. They actually know. They've been in this space for a lot longer than I have, so they could probably. They might not do it publicly. Is there a way to open up the line at all?
Yes,
for
yes,
attendees?
we're working on that. But
Okay.
while we are waiting on fixing that, what would you say is one of the biggest challenges when it comes to deciding between doing an STO and an ICO?
Well, like I said, I mean, ICO, STO is kind of semantics, right? Like, think about an initial coin offering and the concept of it being a public offering of coins or tokens to individuals, then you need to go through, I think you just need to be conscious of that being compliant with securities laws. So really, it's not necessarily that there's, say, a difference, but for me, an ICO doesn't have the same kind of investor protections that an STO might have, and you just want to do your due diligence around what those rights are through that token or coin offering or a future offering. A lot of these ICOs are done through future agreements. The token might not actually be created until the future. Those are all often governed by SAFs, so similar to how venture capitalists use safe agreements. So agreements for future equity, agreements for future tokens can often define the parameters around your rights to within a token or coin offering, versus a security offering that might just be governed through, whether it's through an exemption or through, they're actually doing a prospectus or an offering memorandum filing. Then, like T0 did a security token offering. They actually filed a prospectus for their pref shares. T0 is Overstock's cryptocurrency, so that's an interesting one to look at. So they just decided that it didn't make sense for them to do an ICO because they were concerned around the regulatory aspects, and they wanted to make it available to the public. So that's the route they went. So my personal opinion is to err on the side of caution. It's obviously up to individuals to decide on their own risk appetite and their own risk tolerance around these investments. But to me, ICOs are more kind of either a thing of the past or getting cleaned up, and STOs are the way forward unless there's a true non-security offering within a cryptocurrency per se.
We are having a technical difficulty, with the opening of the line. So I think what we are going to do is that we will post everybody has your email, brad.kirby@dltadvisorygroup.io. So guys, if you have any questions for Brad, you can email him directly. Just also so you know, if you missed anything about this webinar, we will post a recording of it. So you'll be able to play it as many times as you like, and get as much information as possible. So for our next webinar is going to be done tomorrow. We will be talking about the challenges of that companies are experiencing when trying to scale Hyperledger. We'll brush upon Ethereum a little bit as well, but it should be quite interesting. It's not going to be too technical, so if you're not a developer, do not worry that you won't be able to understand what we will be talking about. So it will be very oriented to the business side of things, right? So when all these companies, IBM and Marsline, they're all using these private blockchains, but what challenges they are experiencing when they're trying to scale those projects. So yeah, so if you have, if that's an interest of yours, make sure that you sign up for on our meetup page, meetup.com /TheBlockchainhub, I believe. And there will also be an email sent out to everybody in case you don't know about our meetup page. So yes, so if you have any questions, again, feel free to reach out to Brad Kirby directly, and he'll be able to help you. But thanks so much for sticking around and for joining us. And I wish you a great rest of the night.
Thank you, everyone.
All right. Thank you, everybody. Have a good night. Bye.